Good morning and a very warm welcome back on Business Today Television. Ladies and gentlemen, I am your host Shail Bhatnagar, and we continue with our most important series of Market Masters at a time when there is a crisis of volatility as far as markets are concerned in India because of the ongoing military conflict with Pakistan and of course other geopolitical tensions, and the fact that the markets have turned extremely volatile. We get you to meet Ms. Punita Kumar Sinha, Managing Partner at Pacific Paradigm Advisors, a person who's seen many a bull and bear market, has a very strong grasp on investing and looks at global markets both from the point of view of immediate investment as also from 35,000 feet above. Namaste Punita ji, and a very warm welcome to you at a time when we are grappling with a military conflict on our borders as also extreme volatility in Indian markets. How do you see sentiment on the Lal Street at this point of time, ma'am?
Well, I think first of all, the sentiment in the markets seem to be ignoring all the heightened geopolitical risks. So I would say that there could be, depending on how the conflict between India and Pakistan is managed, I think things could get worse, but markets seem to be ignoring that. So I would I would think that there should be more caution in under the current circumstance. That's in the very short term. But if you look at the medium to long term, wars, anyone who has bought during corrections in a war has come out ahead in the medium to long term because markets do recover um, longer term. And so I think it depends on what your time horizon is. And if you need cash immediately, then maybe you should be more prudent. But if your horizon is a little longer term, then, kind of riding this volatility and just saying, okay, I'm just going to have a buy and hold approach and not do too many things in this environment. That's also another approach to consider.
Punita ji, in your initial part of the answer, you mentioned that Indian markets seem to be ignoring the conflict at the moment, and at the same point of time, we see the Pakistani markets collapsing by a huge percentage fall over the last 2 days or so. What, according to you, would be the reasons why Indian markets seem to be in this nonchalant space, trying to ignore this conflict and hoping that this will end quickly?
Well, I think, first of all, market participants are not fully even aware of all the different things that are going on with the war because it's a very fluid situation, and due to the intelligence considerations, I'm not sure everything is actually being disseminated to the average viewer because governments don't like to create panics in the Aam Janta, right? And so for that reason, perhaps people are not even fully aware of how serious the situation can become and how irrational our our conflict partner, which is Pakistan, could what irrational actions they might take. I mean, how much they're going to escalate that even we don't know. But the risks are rising for sure, and it's something that I think could die down easily, quickly. We don't know. It could get de-escalate or it could escalate very quickly, very rapidly. So, given that uncertainty, I think it's better to be cautious, and the Indian markets are not reacting to it because the average investor who's putting money through SIPs isn't stopping to invest in SIPs. The average, investor isn't running to sell because they don't even know fully what's going on.
Right. So you would imagine, ma'am, or advise at this point of time to continue with SIPs to take advantage of any dips that might arise because of this irrationality in Indian markets?
I wouldn't say any dips, but I would say if there's a meaningful correction, which there might be, because the markets are, given all the uncertainty in the world, the markets have been choppy, but they've pretty much uh, sort of come back, and most of the losses have been sort of erased. So I think there could be another leg down, and in when you have another leg down, at that point, if your time horizon is long enough, that's the time to really accumulate. Because right now, just buying on a dip isn't necessarily going to protect you, because there could be further dips given the situation, because the world is still in an uncertain place. China US trade tensions are still on. India Pakistan war has just started. The tariff discussion is still a concern. In global GDP growth numbers are still being revised down. Inflation numbers in the US have not come down. So will there be interest rate cuts or not? But the markets have ignored a lot of this and have recovered. So, come on, there those things could cause another leg down.
Fair point. You are at equal ease with the U.S. geography as you are with its Indian counterpart. Ma'am, a transaction with the UK in terms of a trade deal in the US, as also the fact that global crude oil prices are now at 4-year lows. Do you still feel that the US is headed for a recession, given that there is intransience with its main trading partner, which is the Chinese government?
Um, well, it depends on how the trade talks go. But right now, the U.S. GDP number forecasts are not showing much improvement, and the inflation numbers are not showing any reduction in inflation. So I think it is a wait and watch mode, and valuations of markets aren't really reflecting that there could be a little bit more pain down the road. But it's a very, as I said, it's very event based year, and it's a very news based year. They're what happens, and it's a year where governments are going to drive a lot of that news flow, and so it's very little control that the in that sense that we as investors have. I mean, the private sector will do its job and keep on chugging along. The companies will keep doing what they have to do. So you have to be in companies that are generally insulated from all of these government interventions and decisions. So to the extent you are in companies that are in Indian consumption themes, that will continue to generally grow even if there's a slowdown, based on our demographics, based on our own domestic demand, insulated from US tariffs. Those are the sectors that you can still kind of, they are more predictable than the sectors that are globally linked. Those are more unpredictable.
But at this point of time, where would you be betting on what horses in India, provided this correction comes in that you're talking about? What would look attractive to you against the backdrop of maybe weakening crude oil prices, maybe a stable macro, a decent monsoon, and maybe some strong show in fourth quarter earnings? Where would you bet fresh liquidity into the Indian market?
I would say, as I said, anything to do with make in India, consume in India, for India. Those other sectors, I think defense is a new sector, infrastructure
Yes.
is another sector. Maybe PSUs might benefit if there's a government capex
Okay.
revival after the war, which typically happens. So all of that would mean, focus on being defensive, but yet very India focused.
Okay, so you would just focus on domestic demand and keep the tariff linked export oriented sectors at bay for the moment, unless, of course, valuations correct. The other theme, ma'am, which would merit your attention is this very sharp fall in IT stocks. Of course, there is a bit of a recovery over the last 15 odd sessions, but do these global IT companies, we've practically grown up with them as far as the last 30 years are concerned, Do they make sense at reduced valuations that they have come down to, or is the impact of the adverse impact of artificial intelligence and probably a recession in the US still to be reflected completely in their numbers?
I think it would have to be each company has to be, we have to see which companies are going to be ahead of the curve and are able to keep up with the innovation that is required and investment in AI and creating solutions for customers, particularly in the US. Um, so I think it'll be company specific, but as a sector, also, the rupee strengthen, and that isn't always great for IT companies. Um, but I think, given the valuations, one could probably start re-looking at them because it's very linked to also the data in the US. So it's a very US linked sector, as I said, and anything that is US linked, trade linked, you have to watch a whole different set of dynamics that don't really involve India. And so,
I think there is an issue with Punita ma'am's link. We'll just get back to you in a moment. I think we have her reconnected. Please continue, ma'am. Okay, we'll come back to the link once we are able to have some clarity on the continued quality. But for the moment, ladies and gentlemen, the Indian markets are testing 24,000 on the Nifty, and that's because of a knee-jerk reaction that happened on overnight flare-ups that were taking place in border towns and cities between the Indian and Pakistani militaries. The gap down seems to have now taken to the extent of about 1.3% on Nifty Bank, 700 points lower, and the IT index is two-thirds of a percent down at about 35,734. Ma'am, we were discussing IT stocks.
yes. So I think, as I said, they're very dependent on the US. So any news
Yes.
flow coming out of the US and the company's own strategy as to how they are innovating and adapting to the new world era of AI and what kind of solutions they can provide. I think that's the kind of analysis that would be required. But valuations are becoming more attractive. So I think if there's more correction, I think at certain valuations they probably start looking attractive again
Okay.
to at least come back in.
Okay, ma'am, since you invest globally for on behalf of your clients, what is the percentage of total AUM that you have focused towards India, and how much of your portfolio is US focused at this point of time?
No, it's two separate sets of clients. The
Okay.
US uh, people are only looking at the US, and the India people that we have clients are only looking at India. So we don't bundle the two together.
Okay. In the domestic portfolio, which is India focused, what is the percentage of large caps, mids, and smalls as a percentage of total AUM managed?
Well, actually, one of the I'm involved in a bunch of different strategies. Um, there are, multi-cap strategies as well as multi-asset strategies, and the multi-asset strategies are long short equities, bonds, gold, and other asset classes. So there we in the multi-asset, we are actually still quite low on our net exposure to equities is still quite low. It's risen a little bit from the last couple of months, but it is still quite low. And our exposure to cash and bonds and gold is it's also there. So we go long and short equities there. And
Okay.
in the multi-cap strategy that I'm sort of chairperson for, there I think it's also defensive. The approach right now is still defensive, which means a bit more in larger caps.
Okay, fair point. And you would be the right person to take a view on gold, ma'am. How is it panned out in your portfolio? Is it the best outperforming asset uh, given the stellar returns that we've seen over the last 6 months or so? Any chance of trimming those positions, or you continue to hold them?
We are, I mean, we rebalance the models, rebalance and qualitatively run on a monthly basis. So at the moment, we are staying put with our gold exposure, and I mean, in fact, added to it.
Oh, that's interesting. You want to add at current levels?
Yeah, our models are, but it's also risk reward versus other asset classes. So it's just given the risk in the markets right now. Next month it could be a different situation. Um, Before the war actually started, we started actually adding to gold.
Okay, that's I think the lone contrary opinion that I've heard about gold in the last 1 month, and let's hope it works really
Yeah,
well
I'm
for
not
your
betting on
invest.
commodities. This is a quantitatively generated
Yes,
uh,
I,
thing.
I
So
I
I'm not
understand. Yeah.
giving you any judgment on this, a personal judgment. I'm just telling you what our models have
Yes,
done.
I agree with you. And kudos to your model, which says to sort of play the momentum, and that is how it should be. If there's something that's added 20-25% in a span of 2 months, that's a rally that has to be ridden on the long side. And like I said, the model seems to be
I
working
mean,
well
and it's
in.
also relative to other asset classes.
Yes.
Um, so in relative to other asset classes and the risk reward trade-off, our models are saying, okay, stay put in your gold allocation and increase it a little bit.
Okay. And because you're focusing on the domestic part of the Indian economy, what would your view be on potential rate cuts from now on? We've had two so far, and the RBI has done all that it can, if not more, to inject and keep the economy liquid in terms of liquidity available.
Well, US is not cutting rates at the moment, and that's the debate we are having with, the fight between President Trump and Jay Powell. So if US doesn't cut rates and India's already cut twice, I'm not sure if India will cut much more at the moment. I think they should wait and see what the liquidity that's been injected is doing. And now, of course, it also depends on what happens with the war, and if the economy needs more support, then that might happen. But I'm not expecting. I mean, the inflation data is showing stability. It's not like it's showing a deep correction, and I think there's got to be more data before more decisions are made.
Fair point. And I think if the rate cycle is paused in the US simply because Mr. Trump and Mr. Powell can't see eye to eye each other, why should we sort of step up on the gas and then have an issue with the local economy? Ma'am, do you think that uh, the overall depreciation of the rupee is done for 2025? Are we more or less at the real effective rate of interest at this point of time, or are there more pains in the pipeline?
See, I'm not a currency expert, so I can't forecast currencies. But the dollar safe haven status is being challenged, and that is why we've seen our currency appreciate. But typically, when tariffs are put, the reverse happens. Currencies typically devalue to offset the increasing tariff. But this time, the reverse has happened, and that's because there's more to it than just a tariff thing. It's like the whole concept of the safe haven of the US, and we've seen as a result the dollar weakening, gold strengthening, some other commodities strengthening, Bitcoin strengthening. So all of those are reacting to the weakening of the dollar, and so I really can't say what will happen to the rupee versus the dollar going forward.
Ma'am, you've had a very strong toehold in the US economy, and at this point of time, Mr. Trump's ratings are the worst they can be after 100 days of being at the helm. One, is it chickens coming home to roost, or how do you see this an absolute about turn over the last three and a half months?
Well, I think it's primarily because of the firing of a lot of federal workers. So a lot of people have lost their jobs, and so they can't clearly be happy with the situation. And then the uncertainty that it's created in the corporate sector on tariffs and their trades and their supply chains and where they will have to manufacture. And for instance, Apple was looking to manufacture more in India, but now with this geopolitical situation flaring up, what does it do to their supply chain? I mean, part of this war is also benefiting China, and is because they don't want to see India emerge as an alternative to China for supply chain and for manufacturing. And so creating this geopolitical uncertainty over India, Pakistan, uh, will just create more fear for US and other global companies that were trying to diversify out of China. And so I think all of these global uncertainty is leading to perhaps popularity of global leaders reducing.
Mhm. I think, ma'am, you've hit upon a very sensitive topic, which is the perhaps the actual reason why this conflict is happening between India and Pakistan. Pakistan being used as a proxy by China to uh, maybe bring down the reputation of the Indian economy as a long-term stable environment for many global supply chains, if not to relocate entirely from China, but to at least set up a strong toehold. What are you hearing from your peers globally? Uh, could this possibly be the reason why Pakistan continues to be stubborn because it has Chinese backing?
See, again, those are foreign policy, foreign, um, diplomats can answer that a lot better, but I suspect it is. There are, different there are different blocks that are getting created in this neo geopolitical regime. India's kind of been seen as on its own, largely not aligning itself strongly with one block or the other. But clearly, one block is the China block. There is a US block, there's a Russia block, and India's kind of tried to be neutral. And now the question is, um, does India and China start doing, China's losing US maybe as a trading partner. Do they want to trade more with India? Everybody wants a piece of India's domestic market and demand. So every country wants India to import more from them. And I think in that sense, India is in a good spot. So beyond a point, countries would like to have good relationships with India, but at the same time, they don't want India rising too strongly, particularly if they compete with them. Say, for instance, this case, India as an alternative to China for certain supply chain disruptions, obviously competes with China, so that wouldn't be taken very kindly by China, and it's that's perhaps why some of this realignment of powers is happening.
What a wonderfully well explained and cogently put thought, ma'am, on possibly the only reason why this conflict continues as of now. My final question to you, uh, this 2-day intergenum that we've had, and apart from the last 15 days, Indian markets have more or less found their mojo on the long side, given weak crude oil prices, the expectation of a good monsoon, decent fourth quarter, and of course, valuations being in the right quartile. How do you see the next 12 to 18 months if this conflict were to be settled over the weekend?
Well, as I said, longer term after a war, markets do well. I don't think valuations are in the most attractive zone yet. Multiples at 20 times with the markets having recovered. I think it's not cheap. But could there be a correction and markets get a little cheaper? The long term story is great. But if markets correct, which they might at some point, that's when I would say valuations are better.
Thank you, Punita ji, for this wonderful 30 minutes of a global top down approach to investing, as also what looks good in India. Here's wishing you the safest of journeys back
Thank
home,
you.
and
Thank
that
you.
we meet very, very quickly once you're back again in India.
Thank you. Thank you.
That, ladies and
Gracias.
gentlemen, was Ms. Punita Kumar Sinha at Pacific Paradigm Investors. She hits it on the nail when says that possibly one of the main reasons for this conflict that is ongoing between India and Pakistan is Pakistan being used as a proxy by China to pull down Indian reputation as a stable economic setup where global supply chains could be set up over the next 18 to 24 months, some of which will definitely move out of China. Apart from that, she's focused her Indian portfolio on the domestic economy, looking at spaces where there is less of tariff intervention globally, and of course she finds merit in investing in Indian equities if you have a further knee-jerk reaction in the Indian market because of ongoing hostilities between India and Pakistan. The Nifty is about 1% lower for the moment, and the Bank Nifty is down about 1.2%. We leave you at that, but continue with Business Today Television. There is a lot that's happening on both the financial markets, the economic markets, and of course on the conflict.
The most telling sign of how terrorists are treated as VIPs in Pakistan.